Hello and welcome to Bidishanomics, our weekly show where Dr. Bidisha Bhattacharya, our consulting editor for economics, takes your questions on global economy, India's position, and anything else. Very interesting questions actually that you send across, and especially this time we have a very wide variety of questions. Bidisha, first I'll start with Wizard Buzz question, and they are referencing your latest article on fertilizer import dependence. They are saying that it was quite eye-opening for them. They're asking, is this dependence entirely due to geological constraints, or does it also reflect deeper issues in India's approach to upstream resource development? Given ongoing concerns about under exploration and limited domestic mining capacity, do you think a stronger push on mining and resource strategy could reduce some of this dependence?
So firstly, as you very rightly stated, the questions are very interesting this time, and thank you for taking out the time to read regarding the fertilizer import dependence piece. So specifically, yes, you are very correct regarding the mining bit, and of course the dependence on fertilizers that as a sector agriculture has. So here I would like to respond to this question not only from one point of view but two specific, one being geology and the other being policy. So first we will address the geology because there are certain geological constraints. For instance, key fertilizer inputs such as potash or phosphatic rock. Say for instance for potash, the right kind of resources, or from a geological point of view, we don't have the right kind of resources, and we cannot mine enough potash. As a result, we are dependent at a global level to another country for imports. Then comes phosphatic rock. That is available to a certain extent for mining, but the quality is quite low. So ye to ho gaye the geological constraints specifically. But does that limit us from sort of specializing in the production of certain fertilizers, and does that limit us, and is that specifically the reason for increasing the dependence on fertilizer imports? Not really. There are certain reasons that are making us strategically vulnerable where we really need to work on. And here comes the concept of understanding that India has a weak upstream capability. Now, what is upstream and what is downstream? Upstream basically focuses on exploration, mining, extraction, and downstream focuses on fertilizer subsidies and fertilizer distribution for that matter. India has historically focused on strengthening the downstream capabilities and focusing on affordability. When it comes to upstream, for some reason, we have not been able to realize and utilize our entire potential. When it comes to the right kind of mining, specifically, globally countries explore 70 to 90% of the prospective terrain. India has not even done half of that. So specifically when it comes to a weak upstream capability, that's something that needs to be looked into. Now, what are the structural gaps in mining? I wouldn't say long back, but last year, December, I had written a piece in The Print, which shows that why India needs to increase the mining and what are the structural gaps that needs to be addressed. So the very first one is, of course, the under-exploration bit that we have talked about, that globally countries, explore 70 to 90%. India has not even explored, areas that have geological potential, to be specific. And this actually creates an information asymmetry for all of us. We don't even know the right kind of resources or the quantity of natural resources that are available with us. Second comes the delays. Here again, that leads to a lot of fragmentation. The delays in general is of environmental clearance. A mining project from discovery to complete production takes 5 to 7 years or even more than that. That's a lot of time. So which is where, these arise because of environmental clearances, structural delays, land issues for that matter. So that is another structural gap that leads to sort of probably not enough mining that we need to do as to reduce our dependence.
Okay.
Then comes something that doesn't get discussed much, which is enhancing or strengthening midstream capability. Now, what is midstream capability is that we depend a lot on raw materials, but we don't have India specifically does not have the refining or the processing capacity of the raw materials.
Right.
As a result, what happens? That India is not only dependent on other countries for raw materials, they are also dependent on other countries for processed inputs.
Okay.
As a result, that weakens our value and that also weakens the strategic control that we might have. So these are the areas where, specifically, as I always say, be it any issue that's happening around the world or domestically, if we can really analyze clearly the problems or the challenges, the solutions appear to us right in front of us. Specifically when it comes to under exploration, we have to do this exploration push overall, where digital clearances or reducing the delays specifically, we have such a strong digital infrastructure that needs to be utilized. Regulatory controls need to be looked into. Data has to be visible to the public.
Okay.
Which are these areas or these regions that have been identified as having certain geological potential that can be mined. So that data needs to be public and very transparent to the country. And also specifically strengthening this midstream capability, because if we don't enhance or strengthen our refining capacity or processing capacity, it will be a big hit regardless of how much we mine. If we don't build our capability in that area, we will always be lagging behind and be in a strategic vulnerable position at this point in time. So I believe that will more mining help us or put us in a better position? Yes, to an extent, partly not, because of the geological constraints that we have. But definitely, if we identify these loopholes, these areas, and address them immediately, we will be in a much safer and a much strategically, from a strategic control point of view, in a better position.
Right. Now, Bidisha, we've discussed our policy in terms of our processing capacity and our political and also geographical limitations. Now, the next question, also by Wizard Buzz, takes us to monetary policy. They're asking, given the RBI's decision to hold rates despite rising global uncertainties and oil inflation risks, do you think the current wait and watch approach could delay necessary policy action if inflation spikes later?
Now, this is quite a sharp question, I would say, because this directly hits at the point where we can discuss on how central banks think about inflation. Okay. Now, there's a misunderstanding that needs to be addressed here. Inflation is not just one definition. There are two kinds of inflation. One is headline inflation and the other is core inflation. Now, headline inflation is something that you see in the news usually, that incorporates food, fuel, everyday prices basically. And core inflation are the ones that removes this food and fuel, the ones that can, any kind of disruption globally can lead to immediate spikes in prices, for instance fuel prices or food prices or grains for that matter. And so core inflation kind of addresses the real deep demand pressures in the economy. The RBI in general, or any central bank, now let's address the RBI. The RBI looks at the core inflation when it is making decisions. Usually what happens, the core inflation numbers are not the ones that are very much visible or available to the public, because in today's day and age we just look at the headline and we make assumptions. So when it comes to what's happening right now, given the world order and the tensions in the Middle East, because oil prices have been impacted, food prices have been impacted, and so have fuel prices to an extent. We are still not, we have not experienced huge amount of petrol price rise or of that sort, but in general, in some way or the other, they have been affected. As a result, headline inflation might be showing a higher number, but the core inflation is at a moderate level. Okay. As a result of which, the RBI
Bidisha,
has...
Me being an economics noob, what exactly is the difference between inflation and core inflation?
Yeah. So inflation, basically headline inflation and core inflation are kind of, they come under the umbrella of inflation. Okay, inflation in general means when prices rise because of demand pressures or supply pressures. It can be, as we spoke about, cost push inflation earlier. So these two come under as two sub definitions of the entire definition of inflation, right? So headline inflation takes care of all the commodities, food, fuel, different on a day to day basis things that you purchase. So which is why any kind of global oil prices spike take place, as a result of which our fuel prices might be affected and the headline inflation will immediately spike. But core inflation removes these commodities. It only looks at the long term commodities, the deep real demand pressures that might have been generated in the economy. So this is where RBI looks at the core inflation, and now the core inflation is at a moderate level. It has not spiked up. Headline inflation has seen a little higher number, but not core inflation. As a result, the central bank has decided that no, we will not change our stance, we will keep a neutral stance and we will wait and watch. That's the exact term that has been used by the governor, and very rightly so, because I'll tell you why. Here I've written recently a piece regarding this. After a while, after quite a bit of time, this is the very first time where we are seeing that it's not the actual parameters that are sitting in the driver's seat, it's the expectations that are taking the lead role. So if I talk about inflation, it's not inflation as a number that markets, investors, people are looking at, but the inflation expectations. Where are prices going to go? If this war continues in the long term, the prices are going to rise, and as a result, how things are going to behave. Now, what's happening as a result of this is that if people expect prices to go higher and higher, workers will demand higher wages. Now, if workers are demanding higher wages, the firms will say, fine, we'll have to now pay higher salaries, so they will increase the prices. If they increase the price, it's like a second round effect that's happening in the entire economy. So if they increase the prices, the inflation increases even further. And right now, the RBI is not acting because the headline inflation numbers are very temporary. They are not permanent. Tomorrow the war stops, or even, if, the oil prices kind of come down or global demand for oil weakens, जो कि usually एक recession में हो जाता है. At times the global demand weakens, so then oil prices come down. As a result of which the headline inflation will again come down, but the core inflation is the exact number that they look at and they decide. So, at this point in time, of course, now very rightly this question has talked about delay in policy action. Of course, whenever monetary policy is implemented, there is a time lag of 6 to 12 months. After that, we can see the impact of that policy action. But even at this point, are there risks associated? Yes, there are risks associated, because sometimes what happens is headline inflation can trickle into core inflation, and that gets risky. Now, how does the central bank, or how should the central bank ensure that that does not happen? That's where another concept comes into the picture, which is the real interest rate. Not nominal interest rate, real interest rate. Real interest rate is basically, the nominal amount minus the inflation. So removing the inflation, what is the current picture? Now, if the real interest rate is positive, the monetary policy is kind of restrictive. If the real interest rate is negative, then it kind of gets a little stimulative. Right now, the rate is positive. As a result of which, RBI is obviously being very, very careful. They are waiting and watching, and hence the wait and watch, I wouldn't say is kind of a sign of weakness, but a sign of strength, where, because if they reduce the rate, for instance, or increase the rate, would be rare, but if they reduce the rate, that might unnecessarily sort of, trickle the headline inflation into the core inflation, and that could become dangerous, because core inflation is an inflation that is permanent, that will be there, that will last for a while. So that is something, it gets a little tricky, a little risky if core inflation starts increasing. So that is something that RBI has to keep in mind, and specifically look at indicators, as I mentioned, about not just headline and core inflation, but also real interest rate.
Bidisha, our next question is Also, a little about policy action that has come into play at the moment, because a lot of things are being impacted by global affairs right now. So, the next question is by Bluetooth. They're asking, how much is the central government subsidizing cooking gas and petrol at current dealer price with the rupee depreciation approximately?
A very interesting question, because I'm actually grateful that this question was asked, because we don't discuss much about the kind of subsidies,
Right.
and usually subsidy comes across as, okay, fine, like petrol, cooking gas, LPG, every other sort of welfare schemes, let's say, all seem like they are receiving a similar kind of subsidy, which is not true. So subsidies are primarily of two kinds. One is an explicit subsidy and one is an implicit subsidy. And LPG and petrol are classic examples to understand the difference between the two. So first, let's talk about explicit subsidy. Explicit subsidy is one which is budgeted, which is just out there in the public. During the union budget, there is a certain allocation that is made. It is announced, it is recorded. For instance, in case of the liquefied petroleum gas or cooking gas, rupees 300 per cylinder. Now it has become more of a targeted support. Earlier it was for a larger section of the population. And of course also the government kind of parks or allocates 10,000 to 12,000 crore annually for this particular subsidy. Here, this is something that's out there, everybody knows, okay, this is a subsidy that's going for LPG. Petrol has a different angle altogether. Now, petrol receives what we would call an implicit subsidy. Now, before I get into explicit or implicit subsidy, I should have mentioned, what does subsidy exactly mean? Subsidy means something as a result of which the consumer is paying lower than what the true economic cost is of that commodity. That is what subsidy is. Right? There can be different forms of that. So now coming to implicit subsidy. Now, from an explicit or a subsidy point of view, petrol does not have any explicit subsidy. Petrol receives something which is, there are two organizations or more than organizations or two areas that absorb the shock that otherwise petrol prices might have to bear the brunt of. This is where implicit subsidies come into the picture, which is not transparent, which is not sort of budgeted or announced, or the data is out there. Let's take, for instance, which are these two hidden areas that absorb the shock. Number one is tax foregone, government. Where government enters into the picture. Now government charges a tax which is called the excise duty. Now whenever oil prices rise, or there, even like, let's take the classic example of what's happening right now. So when oil prices rise, globally, and there are disruptions of oil, what the government does is, the tax that they would have charged for this increase in price, they don't. So that is the tax that is foregone, the revenue that they would have earned from the consumers. They don't push that into the price. So as a result, the rupees 10, let's say, that was there earlier itself, consumers are paying that amount, and they don't see, and as we are seeing in the data, there have been multiple reports that apart from premium petroleum prices have not been affected as much right now in India. Then comes another, which is oil companies. So they do something which is called price smoothing. Okay. So now this is where, or under recovery, where oil companies like, Indian Oil or BPCL, HPCL, what they do is they absorb a part of the shock, and they keep the actual price that the petroleum, for the petroleum that consumers are paying, as it is, and any extra amount of money is something that they pay. They absorb it. Now, this is the implicit and the explicit subsidy story. Now coming to the rupee depreciation part of the picture. Now India is dependent on oil. India approximately imports 85 to 88% of its crude oil requirements. And right now, the strait that we are talking about, or the critical choke point that we are talking about, is through which 1/5 of the oil that is traded in the world is passed through. So which is why Strait of Hormuz is kind of affecting the true cost of petrol in multiple ways. what happens is when oil prices rise and these implicit subsidies or explicit subsidies are not applied to a great extent, that immediately will lead to fuel price increase. Now, sometimes, usually during politically sensitive times or elections, this is highly taken care of, because right now we have multiple state elections that are taking place. As a result of which it would not look good if fuel prices hiked, left, right and center. So now what India is doing currently is they are doing a mix of implicit subsidy through government, the tax foregone bit, as well as the price smoothing bit, which oil companies are taking responsibility for. Now, does that work in the long run? Of course not, because in the long run, we will see if this war continues, if the oil prices keep going high, then what we will see is, of course, our current account deficit will keep widening because our import bill will increase. We will have to pay in, higher amount for the same quantity of oil that we are purchasing, and as a result our rupee starts weakening even further against the dollar. So of course in the long term we will see the impact of it, but in the short term, of course unlikely. And right now, I have a feeling that this is the perfect combination that's going on, where there's implicit subsidy for petrol, which is why we are seeing a stability in the prices of petrol, and the price smoothing bit from the oil companies.
Right. Bidisha, now we're talking about supply chains for resources that have been disrupted due to the biggest conflict that's happening in the Gulf, and of course, the Strait of Hormuz being used as a choke point. The next question is on this by Sunil. They're asking, can India end up with less oil and gas import bill in months and perhaps years to come, because it could become a buyer's market on back of disruption to supply chains due to Iran war?
This is quite an intuitive question, but now what happens is, in economics, sometimes intuition can be a bit misleading. Now, before we get into whether there's a possibility of India becoming a buyer's market or not, first let's understand what is a buyer's market. A buyer's market is where supply is abundant, but the demand is weak. As a result, what happens is this: the creation of buyer's market. I'm telling you the process. There is high supply and weak demand. As a result, sellers start competing with one another as to who can sell and supply the quantity. So prices fall, and buyers have the opportunity to choose from whoever they would like to purchase, wherever they're receiving lower prices. That's a buyer's market situation. Now, the question one needs to ask here is, given the geopolitical disruption, given the oil price that has been disrupted, is there a possibility of demand of the buyers getting affected or the supply getting affected first? Now, this is a classic supply shock that is taking place. And at this point in time, in short term, definitely, even with an input, a systemic input like oil, even in the long term, reducing this demand is very tricky, because oil is an input which is utilized in every possible sector. You name it, oil has been utilized: manufacturing, services, innovation, agriculture, everything for that matter. So here what happens is, a buyer's market becoming or developing into a buyer's market might be a little tricky until and unless the import bill that India is paying reduces. Now, how can that reduce? There are three possibilities. One is, if the global demand falls, as I was saying, suppose there's a recessionary issue and everywhere there are layoffs taking place. As a result, of course, the demand for any input, every input will fall. So the demand for oil also will fall. As a result, oil prices will go down. Now that obviously leads to, the demand being there, but the demand also reducing, supply is there. So that is slowly moving you towards a buyer's market. So there's another possibility where OPEC or US shale, they decide to increase the oil production. As a result, now supply is suddenly ballooning, demand stays as it is, right? This is also a possibility where the import bill goes down. And of course, there's another possibility where India gradually starts moving to more renewable energy, resorting to more renewable energy and not being heavily dependent on oil. So which is where there it will show that, we are not as dependent on oil as we were earlier, so our demand falls. that is one possibility where we can hint towards moving towards a buyer's market. At this point, it's a little tricky. Of course, there can be people arguing and saying that no, our demand for oil is so high, so we might be receiving discounts, certain discounts from suppliers as well. 85 to 88% is a significant quantity. So at this point in time, but that is a very micro level, a little bit of discount that won't disrupt the market completely, or change the demand situation completely. And at the same time, you will be noticing something that lately has been happening, be it for a currency, be it for an asset, be it for oil prices. Every country is now looking to diversify the sources of importing. So if that diversification happens, even India is doing that. Multiple countries are doing so. They have realized, one after COVID and now after this particular situation, that we cannot be dependent on one single source. That's risky. So which is where I feel if that happens to an extent as well, there's a possibility of buyer's market. But right now, it's a supplier's market. It's a seller's market.
Quite interesting to see it that way, because I don't think any of us are able to dive that deep into everything that happens and goes on behind. The next question I want to take is by Rima, one of our very loyal members and loyal viewers also. They're asking, taken together, do France's gold repositioning and Iran's stance on charging for passage through the Strait of Hormuz reflect a deeper realignment in global monetary and energy geopolitics?
This is quite a sophisticated question, I must say, because these are two different things that are happening in different parts of the world, and usually nobody would see a connect at the first go, but there I feel, this question has made me ponder over and see that there is a deeper meaning. The meaning is, it's excellent that you asked this question after the previous conversation, Sabika, because as we were talking about the diversification bit, both of these happenings are rising out of this reluctance of depending on a particular source or a particular risk. Let's first talk about France or any part of the Europe. They hold any which way a good amount, significant amount of gold reserves. However, this buying of more gold is taking place, or increasing of gold reserves is taking place, because they want to reduce the dependence on one particular currency for any kind of transaction, any kind of trade. And that happens in any form of geopolitical disruption or war-like situation. And understanding that usually what happens is these central banks hold reserves in the form of US dollar, in the form of euros, in the form of gold. So now, of course, euro as a currency is not as strong as the US dollar at this point in time. But when it comes to gold, gold is, an asset that has no liability, that is not controlled by a single country. So it is coming across as, in difficult or uncertain times as a very safe asset. So which is why, France has been doing so. At the same time, when we are talking about oil, because, this tension in the Middle East has made every country realize that we cannot be completely dependent on the Strait of Hormuz or that area for all our oil imports, and they have been diversifying in areas. And of course, the other countries that are interested in exporting oil, they are supplying the oil at lower prices. So new markets are being developed, new markets are being generated. So this is a classic example of two things happening at the same time in two different parts of the world. They might not have an economic connect directly, but both of them are doing so with the intention of moving away from being entirely dependent on one single source. So I believe that is the reason. Do they have a direct connect? Right now, no. But of course, very interesting to see and watch, how far this basically goes. From a trade point of view, from an import point of view, this is excellent, because this automatically opens up opportunities for so many other countries to expand their, trade from an export point of view. And if they expand their trade from an export point of view, their production will increase. As we were talking, I have multiple times extensively spoken about the product complexity index. Every single country tries to climb up that sophistication or that complexity ladder. This is a very opportune moment for for them to do that, because multiple countries are also, there is demand, and the countries are also sitting to supply because of certain restrictions or disruptions that have happened as a result of war.
Right.
So yeah.
Bidisha, that's quite interesting, because it's always so interesting to map patterns of how different states are responding to global triggers or stressors. The next question is by Krishna, and they're asking, in your professional opinion, are Indian and US stock markets bubbles?
Quite an interesting question. So specifically, it's important to understand what leads to a bubble. A bubble is when prices rise far beyond reality. Okay, it exceeds earnings to a great extent, and the prices are rising very fast. That kind of creates a bubble. Now, what is happening at this point, as I earlier stated as well, we are highly dependent on inflation expectations right now. Everybody, be it the markets, be it the consumers, be it businesses, firms, they are looking forward to how prices are going to rise and to what extent, instead of what is the price right now. That is there, but that is kind of a secondary factor. Now, when you enter into the market and you decide to invest in a company because it is doing well, that is called investment. If you enter into the market and you decide to put your money in a company hoping that it will do well, that's speculation. Right? And when speculation starts dominating investment, that gives birth to a bubble. Right? And in this situation, it's important to understand the PE ratio, or the price to earnings ratio. The price to earnings ratio is basically how much do you earn, or how much do you pay, the price that you pay per unit of your earnings. Now, let's first take the US market. Let's take S&P 500 for that matter, right? So here in S&P 500, so usually if the PE ratio is higher, then the market is expensive. If the PE ratio is lower, the market is cheaper. So S&P 500, the current PE ratio is approximately between 26 and 27. And the average long-term rate is around 18. So clearly the PE ratio is much higher than the average rate, which shows that there might be a possibility of the bubble. However, it's important to look at the other side as well. Corporate earnings are growing at a very strong pace in the US market. Tech giants are also performing really well. So this is not a blind speculation. Hence, at this point in time, the market, we can say the US market is expensive, but they are not moving towards a bubble. Now coming to Indian markets, let's take Nifty 50. Now in Nifty 50, the PE ratio currently right now is approximately between 21 to 22 or 20 to 22, and the average rate is 20. There is again slightly more expensive, slightly or a little bit overheating, I would say. But this is about the large caps that we are talking about. Here the story gets a little tricky, because when we look at the small or the mid cap, there we are seeing that the PE ratios are going till 30, 40, 50 plus. That is a bit risky. Now, what do we do? Just the way we've done for US markets, we look at the earnings side. Prices are increasing, are the earnings also increasing at the same pace? In case of small and mid cap funds, what is taking place is that there are huge flows of money through SIP that is taking place there. Now, it's very similar to, say, for instance, people are being forced to buy houses at a time when house prices are expensive, but because, there is money. So as a result of which, what will happen? The prices will keep rising even further. That hints at the risk of a bubble being generated. So from the small or the medium cap section in India, I would say that there is a possibility of a bubble-like atmosphere or situation that might be created, but not from the US market point of view, because earnings are very strong there. It's just expensive at this point. And even the large cap from the Indian market perspective, even they are in a good position.
Right. Now we're talking about India's position in the global markets, and Lakshay Verma's question is, a little related to the IMF ratings. They're asking, is the updation of GDP base year to 2022 to 23 likely to upgrade IMF rating for India's national statistics? What are some other changes that can be done for better estimates?
Yeah, definitely. So, of course, and now we know that the base year has moved
Right.
to 2022-23, which should have been done earlier. But of course, now we can factor in the GST formalization bit. We can factor in the digital payments, the digital infrastructure. There have been a lot of improvements, a lot of new indicators that need to be factored in the GDP calculation. Now, the question is, will that immediately improve the rating? No, that's not how IMF functions.
Okay.
IMF will look at how is your informal sector being recorded? How is that data being updated? IMF will also look at your faster approvals, the time delays, how much of formalization has taken place. If you're talking about digital payments, proper record of the digital payments, proper institutional efficiency. So these are the areas that IMF will look into before giving a grade, moving from C to B to A for that matter, not just the GDP collection bit. So now, as a result of which, IMF will not just look at the GDP calculation or the incorporation or the movement from the base year 2011 to 2022-23, but also exactly the points that I mentioned, specifically, especially the informal workforce, the informal sector. How is that data being collected? Also from a consumption, we have a weak consumption data collection. Sometimes production-led GDP and expenditure-led GDP, technically they should be equal to each other. But however, sometimes they are not equal to each other. So these fallacies and these gaps are looked into by IMF before giving a grade. It's not just the base year period. So I would say these are the factors that also IMF would look into, and specifically we should focus on as well.
Okay. Bidisha, our last question is actually a follow-up on our previous episode. This question is by Senapati. They're asking, in our previous episode, we had discussed how decentralization of power at the local level can benefit the economy. Now, the question they've asked is, does our quasi-federal structure provide enough space for competitive federalism among states, or would greater state autonomy be more helpful for the economy?
Firstly, thank you for following every episode so closely, and definitely a very good follow-up question. Firstly, it's important to understand what is competitive federalism and is India operating under competitive federalism or not. So competitive federalism is basically, as we had discussed a little bit in the earlier episode, is that when states start competing with each other for investments, where they say, hey, we have better infrastructure facilities, we have better tech, come to our state and invest here. So this is basically a competitive federalism kind of a structure. Does India operate in this structure? No, not really. India kind of operates in a cooperative structure with a little bit of competitive federalism, or let's say emerging, if we can be optimistic about it, then emerging competitive federalism, which is where center has the major control. State does have certain sort of powers, but from a fiscal or a constitutional perspective, center holds the major autonomy or the control. Now, in this particular environment, of course, what takes place is there are delays that happen when it comes to execution or implementation, because states and local governments understand their regions much better. As a result of which, if competitive federalism could be enhanced a little further, it will lead to an overall growth structure. There are risks associated with it as well. There will obviously be faster growing states. If I'm talking about competitive federalism, a classic way to know as to that the competitive federalism exists in India is, let's say, Gujarat versus Maharashtra. They are competing for manufacturing. Tamil Nadu versus Karnataka. They are competing for tech, innovation. These are specifically the area or the examples that I could just think of. So, of course, if once you enhance that competition, that would lead to overall growth, because every state or local government as well, they will try to bring out the best version of themselves.
Right.
So as a result of which, that will lead to overall growth, not only at a micro but as well as at a macro level as well. So now, what are the disadvantages or the areas to be careful of? Of course, one, as I said, there'll be some very fast growing states and there'll be a weaker, economically weaker states. So from a fiscal transfer perspective, the center needs to look into that. Second comes the policy coordination bit. If every state starts having different rules and regulations for businesses, it will be very difficult for businesses to operate across states in the country. This is specifically, how I think the best structure would be cooperative as well as competitive federalism, where the center basically looks at us from a stability point of view. They take care of the fiscal transfers, because right now states are dependent a lot when it comes to taxes, when it comes to finance commission transfers, as a result of which when it comes to decision making or taking decisions for their own firms or own implementation, they have to be dependent on the center. And sometimes the center might not understand the exact need of that particular region or that particular state. So I would say that a perfect combination of cooperative as well as competitive federalism would be necessary.
Right. Bidisha, this was such an incisive conversation that brings us to the end of the episode. Thank you so much for sending us questions that take us to so many places and that keep us so sharp and make us think harder about things that we talk about every single day. We'll be back next week with another episode of Bidishanomics.